All right, so we are right now seeing some weakness in North American stock trading, and the bond market is as important in this story because we've seen a sell-off in bond spreads around the world. The Treasury 10-year yield in the United States getting to the highest level of the year, and that also puts some pressure on stocks. A lot of this was sparked by some solid economic readings. But you've also got a rally in commodities as well that we're tracking. Let's bring in Adam Johnson, who is the author of the Bullseye Brief, for his perspective on the market momentum. It's the second quarter. We're off to an interesting start here. Volatility aplenty. What do you make of it?
Well, John, actually, it's just more of what we've seen already over the past several months, and that is an accelerating U.S. economy. That's good news. But of course, in the current paradigm, John, that means, oh my gosh, the Fed is not going to cut rates as fast as we thought. How horrible, as if rates were the sole determinant of stock market value. Eventually, John, we're going to get over this whole inflation thing, this whole FOMC, Federal Reserve obsession thing, and we'll be able to just take good news as it is. Good news, the economy is growing. People are employed. They're out there spending money. You can't get a room at the Wynn Resort in Las Vegas on the weekend. Totally booked. Look at the cruise lines. They're knocking the cover off the ball. Delta Airlines is not able to bring on any more aircraft, but it would like to because of some of the problems with Boeing. So if you look at the consumer and what's actually happening on Main Street, not the worry warts that you see on Wall Street, just trading algorithmically based upon bond yields, the world's doing pretty well, and so I remain fully invested, John.
Okay, helpful context as always. Let's talk a little bit about technology specifically, only because that had been the driving force, particularly of the S&P 500 over the last year, more than that at this point. But we have started to see on up days an extension into other sectors. And so tech, if I look at the last, call it month or so, based on the S&P 500's infotech subgroup, is negative, whereas you've seen this interest in some of the other sectors. You've looked at the historical performance of tech when people are worried about things like, whether we've gone too far, too fast. What's your conclusion?
Well, you raise a very interesting point, John, and that is, while tech has been certainly the strength in my portfolio, but look, the strength in the market, and that's why I've been long all these FANGs and the semiconductors and everything else. As the rally starts to broaden out, suddenly a group like industrials is starting to outperform, again, as you just pointed out. In fact, I think it's fascinating. You probably know Chris Verone of Strategas Research, wonderful technical analyst. I read his notes, and he pointed out very astutely that right now you have only 25% of technology companies making new highs, whereas you have 80% of industrial companies making new highs. So there actually is rotation. And granted, I'm long a lot of tech companies, so I sort of say to myself, well, that's not great. And yet, hang on. If we're starting to see industrials join the party, that's actually very good, because what it says is the rally is broadening out. And one of the reasons that the bond yields are up and therefore stocks are down today is because 2 days ago we saw U.S. manufacturing start to expand again for the first time in about 18 months. Again, that's not something to be afraid of. That's something to embrace. But right now in this paradigm of what's the Fed going to do, all we can see is the downside of a strong economy. It's so ironic. But yeah, John, you're absolutely right. Industrials are starting to improve. And I think even me, the growth guy, the guy who's in technology, I think I need to start revisiting companies like Honeywell, like Rockwell Automation, just good, solid, chunky industrial companies.
Okay, and then going back to tech itself, the Tesla stock sell-off today is getting a lot of attention. This seems to be a story on concerns about short-term electric vehicle demand. Tesla this morning came out with their first quarter delivery numbers, the number of vehicles that they delivered. They posted a print that was below Wall Street expectations, and it was less than what they delivered in the first quarter last year. So that's got a lot of people feeling nervous. Stock's already lost in the neighborhood of a third of its value this year. What's your take?
I've never owned Tesla, John, because I thought it was kind of a cult stock. It was the Elon Musk cult join the bandwagon stock. And now all of a sudden we're seeing something that you just described as short term. I don't know if it is. You said, there appears to be a short-term decline in sales. I think what people are wrestling with is whether it's a long-term. In other words, has everyone who wanted to buy an EV basically bought an EV? And now what we thought was going to be a market that would grow 15 or 20% a year is maybe going to grow at half that. John, I will tell you, I have had to cut all of my clean energy stocks from the charging station stocks like ChargePoint, what a disaster, to the solar panel stocks, Sonova. I've been one of the believers in clean energy, but I'm not sure that I can be, John. Part of the problem is that when rates were at zero and the government was subsidizing all these things, earnings didn't matter. And now all of a sudden, rates as high as they are, and maybe staying kind of elevated a little longer than we thought, all of a sudden, subsidies aren't good enough, and these businesses have to stand on their own. And if you can't sell EVs without subsidies, can you really justify Tesla trading at a 50 or 60 PE ratio when Ford is trading at a 6 PE ratio? And by the way, pays a 5.5% dividend. I'm long Ford, I'm not long Tesla. So I will tell you, all the clean energy has not worked for me. I've sold them. I'm not going to buy Tesla even on the dip.
Okay, helpful context there. Before I let you go, let's get to some of your picks this time round. Since we've been talking about this tech theme, let's talk about Marvell.
Oh, yeah. Marvell went up to all new time highs a few weeks ago, came out with earnings, and then traded down about 20%. And I'll tell you why. It's not because earnings are down. They guided up, and all the analysts in turn raised their estimates and targets. But what Marvell said is something that Palo Alto Networks, the cybersecurity operator, said. They're moving some clients from quarter-to-quarter bookings to longer-term bookings. And as that happens, some of the revenue that might have been booked in the first and second quarters of this year probably gets booked in the third quarters. Clients have to adjust to buying, one-year deals instead of just quarter-to-quarter deals. So I think there was a misunderstanding. So I am absolutely buying Marvell on the dip. It's a wonderful company. It powers AI. Don't think about it. These are the guys who basically focus on the storage side of artificial intelligence. You need massive databases and semiconductors that can route all the different information into those much more complex three-dimensional databases than we've ever seen before, simply because under AI protocols, you're slicing and dicing data in much more complex ways that you never used to do. So yes, buy Marvell on the dip. And again, I own it. I'm talking my book, but why wouldn't I? I'm not going to talk someone else's.